Welcome to the Urban Wall Street Project. I'm your host, Earl Christian III, of course, and today I have a very, very important show and a very serious show. You know, we've always been very focal on educating you on financial matters and financial literacy and investing practices and just the overall understanding of the economic climate of America and how you can position yourself to be in a better status, if you will, and a better position. Well, today I have a very special guest, an HU brother of mine, who's an entrepreneurial investor, whistleblower, truth teller, a Wall Street expert, if you will. He's going to drop some science, some knowledge, and some investing strategies, do's and don'ts. And we're going to talk about some things, and specifically the next new bubble, which is the education bubble. He'll get into it. He's predicted the collapse of AIG, Lehman Brothers, Stearns. He's been seen on CNN, Bloomberg Television, any of those financial shows. He brings it. So without further ado, I want to introduce my brother, Mr. Reggie Middleton. Reggie. What's good, brother?
Nothing much, brother.
Finally. It's been some time, but we're finally getting together, so I'm happy to have you here. Of course, congratulations on all your successes and, speaking the truth and dropping that science when we need it. But what I want to talk about, because I know you've been successful and a lot of people want to know, and they don't necessarily know where to begin or even who to speak to, and that's investing. So we're going to call it Investing 101. And for my Lehman brothers and just my average viewers who want to change their lives, who are recognizing what's going on in America and not knowing how they should go about it because you don't know who to trust with so many different schemes and collapses. But we're going to get into it a little bit, and you'll share some of your insight and your knowledge that can help them successful. But before I get into it, first let my audience know that doesn't know, who is Reggie Middleton?
Okay. Well, Reggie Middleton is I'm a serial entrepreneur. Basically, that's two ways to explain that. I've always tried to do my own thing, create my own gig, or B, I'm perennially unemployable, so it all depends which way I look at it. The reality situation is a little bit of both. My mindset is freedom, truth, equality. Sounds like one of these, preambles of a Superman movie or something. But what I look for is I have a skill or a talent, which I actually didn't recognize till maybe just a couple of years ago. I'm able to see value where other people don't. I'm able to judge character. So if I look at a CEO talking, I listen to him for 15, maybe 30 seconds. I say, yo, he's lying. Where, a lot of people take him at face value. A lot of people who should know him in the industry believe him. And I'm able to see where his words are somehow departing from actual reality or fact, even if I'm not well versed in that fact. So that skill mixed with the skill of simple math. I'm definitely not a mathematics whiz,
right.
So high order, mathematics is not me, but 2 + 2, I always get the 4. I've always been good at that. Simple addition, I was good as a child. And as of late, over the last 10 years, if you look at a lot of investment opportunities, you look at busts, you look at the bubbles, that simple equation is what enables me to determine whether there's value there or not. During the bubble, 2 + 2 started to equal 6. And when it equals 6, I know there's something wrong, or at least everybody says it equals 6. During the show of a bust, when 2 + 2 equals 3, again, there's something wrong. So it's really simple,
Right.
The best advice that I could give to anybody is advice I give to myself and my children. And that's just to always do your own homework. There are no shortcuts.
Right.
If there's something you don't understand, then by definition, you shouldn't be involved in it.
Okay. Now, I know you started, when we all got out of Howard, we went different directions, but you started a hedge fund, correct?
No, out of Howard, first thing out of Howard, I started working for an insurance company, Prudential.
Okay.
I wanted to get in sales. I wanted to do the Wall Street thing. Didn't have the proper guidance and got more on the retail side of things of what I initially wanted to do. And then from there, I did a .com. I actually went on my own after the Prudential. I went on my own insurance, did risk management for municipalities and political subdivisions, school district, things such as that. And then from there, I started a .com, my own .com, called the technology bug. Again, another bubble, right? Mm-hmm. And after the .com, I went into real estate. Started investing in residential real estate, downtown Brooklyn mostly. The Fort Greene area, Clinton Hill.
Yes.
And initially, I made money from fundamentals, strong fundamentals, gentrification. Brothers like yourself who graduate from Howard, they move into, areas that were traditionally lower income, mm-hmm. And then with your college education, you actually brought higher rents, and the higher rents increased the value of the property. And when the property value went up, then you had different stores, restaurants, cool restaurants, etc.
Right.
And that started bringing the attention of others. And others come in, with higher incomes, higher rents, higher incomes, higher rents, higher property values. And that's how gentrification works. Most people don't realize that, downtown Brooklyn area was actually gentrified by brothers and sisters first, and
right.
So it wasn't necessarily a racial thing, it was more of a socioeconomic thing. But when it gets carried away, and then you see, the difference in, the race comes, and
right.
Downtown Brooklyn now looks very different than it
Very
did before.
different.
Okay, but when I bought my rental properties, I would go through the actual numbers to make sure everybody was a decent credit risk, and it was the college graduates, a lot of the HBUs, came in, and they came in with stronger salaries, and they actually gentrified the area. Which is a good and a bad thing, but don't get in a political argument. But that gentrification enriched a lot of those who want to hold on to their property value.
Definitely.
Yeah.
So clearly, coming up out of Howard, you knew what you wanted to do. So you knew you wanted to get into business, surely. And that's a beautiful situation. And clearly, you've been successful with it. And we're going to talk about, when you realized you were able to see what other people couldn't see and start dispelling some of these myths and bringing the truth where other people wanted us to swallow. We're going to take a quick break. We'll be right back with my brother, Reggie Middleton. Hi, I'm Earl Christian III, creator of the Urban Wall Street Project and the Urban Wall Street Young Producers Program. For me, proactivity is imperative to one's success. I say this because what you do and what you decide you're going to do will determine the outcome of your life. I recently participated in a career day at a high school, and many of the students were interested in an internship or seeing how they could be a part of the Urban Wall Street Project or the Young Producers Program. So I started thinking, how can I really help these kids? How can I give them an internship that'll not just benefit them from a production standpoint, but also financial? Thus, I came up with the Urban Wall Street Young Producers Marketing Internship. This internship is going to serve the students in a variety of capacities. Most importantly, building financial portfolios for their futures and for college. So here's a snapshot of how the program essentially would work. A student, first year, refers 6 schools over the course of that school year, from the fall through the spring. If done successfully, that's 6 new schools. From each of those schools, the student will receive into their college fund portfolio 10% of that contract. Essentially, at the end of 1 year, a student can have $2,700 in their college fund portfolio. But that's not all. It gets sweeter. Because residual income is a wealth principle, and the Urban Wall Street Project is about creating wealth, you're also going to receive a 5% residual on any of your referred schools that bring the program back for subsequent semesters. So now, schools that you referred in your 9th or 10th grade year, if they're still bringing the program on when you're in 11th and 12th grade, whether you've moved on or not, because once a young producer, always a young producer, you're still going to earn referral fees. So that could essentially put your allocation into your college fund of over $15,000. The key is start your life on a good financial track, be proactive, take advantage, and beautiful things can happen. If you're interested in learning more about the Young Producers Internship Program, check out some of the information to follow. Reach out to us at info@youngproducers.tv.
Hi, ladies and gentlemen. My name is Dr. Keith Kelly. If you want to be mentally and financially enriched, check out the Urban Wall Street Project at UrbanWallStreet.tv.
Welcome back. We're still sitting here with my brother Reggie Middleton. Investing 101 is our topic. Now we're going to talk about, his career. We learned a little bit about the man behind the movement, but we're going to talk about his career and where I was preempted thinking it started with hedge fund. It was some other things before that, but we're definitely going to talk about his entrance into the hedge fund game and how he changed that and how it changed his life. So let's talk about a hedge fund, because coming out of Howard, brother, a lot of us, we didn't even know about a hedge fund. So explain to me how you even got involved in that and how you were successful.
Okay, well, I was one of those who didn't really know much about hedge funds. So what I did was I was feeling my way around from a historical perspective. After, as I was doing the real estate, and I didn't do a lot of deals, I did very few deals, but my mindset was you do a deal, you try to make as much money as possible with as little risk as possible. So I did distressed real estate. And my business model was to, create a portfolio, create a small legacy to pass on to the children, etc. So I would buy, right, distress, fix whatever problem that made it distress, had an income producing, right, take some money out, use it to buy another one. And it's usually had to roll on and on and on. Right about 2005, it got to the point where I couldn't find anything that justified my investment, even if it entailed me selling a property and rolling the money into the new property. You get a tax break when you do that, but even with that tax break, things were getting so overpriced, 2 plus 2 started to equal 6 again.
Right.
Actually, it's more like 13, you know what I mean?
Right.
And then it got to the point where a couple of people I knew said, I'm becoming a real estate developer, a contractor. These were, cab drivers, school teachers. So when everybody starts to get in the game, that denotes the top of a bubble, basically.
Okay.
You have 99%, 1% of you hear in the news lately, and that 99% has to fund that 1%. That's how the 1% is wealthy. It's really an issue of timing. Once the 99% get a hold of something that's popular,
right,
it's already too late. So 99% is buying from that 1%, and then when you're into the bus and everybody gets dejected and they're ready to sell, the 99% is selling. You know who they're selling to, right?
Right.
That 1%. So the key is you have to think, ahead of the game. So I decided to sell off all my real estate. The last completed sale happened in 2005, or first half of 2006. And real estate peaked at the end of the first half of 2006 and then crashed countrywide.
Right.
In many, you can say worldwide in many developed nations, but definitely in the U.S., okay? A lot of people said, that was, excellent timing, you were a genius or you were lucky, but it had nothing to do with being lucky or a genius. Simple math. 2 plus 2 always equals 4. So that simple mindset is what I used to drive me. I took a year off. I had a baby girl. Took a year off, to be trying to be the best dad I could. Yes. And then I was scheming on what I could do, what my next, venture was, what's the next gig. So I looked at the hedge fund industry, and I look at these guys getting 10, 15, 20 times leverage. That means they would take, $100,000 of their own money, and then they go and borrow, $2 million, and then take, $2.1 million and go do a deal with it. And said, if I could get that type of leverage, I think I could make a decent amount of money.
Right.
So the first thing I did was started to open a hedge fund, spend a bunch of money, open up the structures, the legal documents, etc. And my goal was to short, which means to bet against everybody who ever did business with me in real estate.
Okay.
The banks, commercial banks, mortgage banks, investment banks, insurance companies, everybody, because I knew they were just, totally out of control.
Right.
The hedge fund didn't work out as planned. There was actually a hedge fund bubble at the time.
Okay.
Everybody's running into the hedge fund. And the reason is you get 2% assets as compensation plus 20% of whatever you make. If you lose anything, all you do is not get paid, which is a good deal.
Right.
You know what I mean? That means I can take all your money, and after you finish, if you don't have any more money, I don't have to give any money up. So it's just spend your money, not mine.
Wow.
So, it's a good deal. It didn't work out, but one of the side effects of attempting to open a hedge fund, you're not allowed to market a hedge fund to the public outright. And since I didn't come from Harvard Business School, instead I came from Howard University, since I didn't work on a trading desk at Goldman Sachs, instead I was self-employed, with various endeavors as a small businessman, I said, let me open up a blog and basically publish my thoughts and, show everybody what I'm about, That actually became very popular. I started getting a lot of readers. And it got to the point where the purpose was to market myself, not the hedge fund. When I shut up the hedge fund initiative, I kept the blog going as good exercise. Basically, I just took my thoughts every morning. I wrote them down. I tried to buy research, and the research that I saw just wasn't up to par. It was either overpriced, inaccurate. Most of it was inaccurately overpriced. So I hired my own analyst, right? Because I tried to do a lot of research myself. It was time consuming. So I hired my own analyst. I created my own food, and basically I ate it. And that's what I did to invest my own money. I had spectacular returns by shorting all these banks. I predicted Bear Stearns, Lehman Brothers, General Growth Properties, which is the second largest small development company in the country. a list of about 67 companies, you know, the fall of Goldman Sachs when it dropped, Morgan Stanley, et cetera. So this got me a lot of notoriety in the media. That's how I did the CNBC appearances.
Right.
I call it the housing crash, of course, the commercial real estate crash. So I had this little mini aura of a guru, when in actuality, I'm just extremely good at second grade math again, you know what I mean? 2 + 2 = 4.
Yes,
but, you know, don't tell anybody.
Right,
you know
we're not telling anybody.
Okay, you know, quiet as
As
cat,
simple as it sounds.
Okay. The blog started to get onerous in terms of the labor of waking up every morning, posting something at 4 or 5 in the morning. So I put a paywall in front of the blogs, and basically said, if you want, you know, this opinion, you have to pay for it. And I know from firsthand, that's one way to get people to leave you alone, ask them for money.
Right.
You know, I'd say 3 days after I put the paywall, I got a call from one of the big banks. You know, one of the big banks out of, you know, the Goldman Sachs, Morgan Stanley crew. And they asked to sign up their strategic trading strategies desk. I think there were 4 members. You know, they asked me for a price. You know, I quoted the price of like $10,000. They said, okay, we're gonna wire it to you, be there tonight. I'm like, okay, sounds good.
Right.
And that's how BoomBustBlog got started in its current form.
Wow.
Which is basically me selling my opinion, investment strategies, and I guess you could say advice, and to, you know, high net worth individuals, mostly trading houses, the hedge funds, and professional investors and retail investors. Basically anybody who wants to know what I'm thinking. You also have a lot of people who actually are not active investors but are interested in, you know, global macro strategies or, you know, corporate valuation and specific interests as well. And that's been going since 2007. It's 2013. It's, you know, almost 6 years now. And what I'm doing is now I'm actually morphing the blog into what I guess can be considered, as we discussed earlier, an apprenticeship. Apprenticeship, social media as an apprenticeship, let's put it that way.
Excellent. So this is what I want to do. We're going to take another break, and then we come back, you're going to share some of your investment strategies that you would suggest and educate your would-be apprentices. All right, so keep watching. Reggie Middleton, BoomBustBlog, Urban Wall Street. We'll be right back.
It's Dr. Mac. Check it out. We're in a little casual setting tonight. I've been out. A lot of guys have come up to me asking me what's my thoughts on razor bumps. Well, the reality is that razor bumps happen because when you guys shave, you shave the hair curls back over into the skin, new skin grows over that area, and then boom, the bump shows up. So here are some of my tips I'm about to share. Number 1, very, very important. I want you guys to shave every day, morning and night. I don't care if you want to shave with a razor, electric razor, or whatever your favorite. The bottom line is that you need to shave every day so that you don't allow that hair to grow above your skin surface for it to curl back over into the skin. Number 2, wash your face with an oil-free acne wash. Even if you don't have acne, I like the salicylic acid ingredient that's in the acne wash that's going to, number 1, dry up the bump, help to remove a lot of those clogged pores, and just really be able to just smooth out your skin. Number 3, pick up a facial scrub. I don't care what's the name brand, what's the type, but there's a lot of products on the market that says facial scrub. I want you to use that every week, once a week. That's going to help to remove a lot of those dead skin cells that's clogging up those pores, and that's going to really help to reduce your risk of razor bumps. Okay guys, the bottom line is you want to shave right when you feel that 5 o'clock shadow, because the reality is if you let that hair grow above the surface too much, it's going to curl back over into the skin, and boom, you're going to have another bump. Another one of my tricks is that the same benzoyl peroxide that I talk about for acne, you can use that, put that on the bump, let that sit overnight, and that's going to help to really dry out a lot of the bumps that are currently on your face. You follow these simple tricks, you'll have smooth, sexy skin back. If you need to reach me, www.drmacklin.com. That's drmaclin.com. Bye-bye.
Yo, what's going on, y'all? This is Queen Aisha, comedian. If you want to be financially stable, you better check out UrbanWallStreet.tv. You got it? UrbanWallStreet.tv. Gotcha.
Welcome back. Still sitting here with my brother Reggie Middleton, BoomBustBlog.com, and right now he's going to share with us 3 investment principles that he feels are sound ideas and ideals for any person who wants to really change their financial scope. So Reggie.
Yeah. Well, principle number 1 will enable anybody to avoid scams like Madoff, or it all depends how you define scam, but Madoff is one of the most prominent scams. And that's basically, and it's what your grandma used to tell you when you were young. If it sounds too good to be true, chances are it probably is. A lot of people want gain. You want significant gain, you want gain now. But that's not the way economics work in terms of wealth building. It takes time to build wealth, okay? And you can accelerate that time scale by accepting more risk, but you have to understand that it's a trade-off. This is risk and this is reward. So if you want to increase your reward, right, you have to increase the risk. Usually when you increase the risk, your reward decreases, because there's a greater chance of taking a loss. Over the short term, over the long term, increased risk will equal increased reward, but it's a lot of volatility. So if you remember this relationship and just think about that relationship, it's very difficult for you to be taken to the cleaners, because if you get something that's low reward, that's low risk and high reward, chances are it's a lie. So in order to get a higher reward, you have to take a higher risk. Okay, that's principle number 1. Principle number 2 is always understand what it is you're getting into. One way to say no to any particular opportunity or investment is not to understand it. There's when derivatives were going bust and blowing companies up, and CEOs were saying, well, I wasn't aware of it, or this and that. If you're the CEO of a company, you're responsible from an ethical perspective, a prudent man perspective, for everything that goes on in a company. Realistically, you can't understand everything that goes on in a company with 200,000 or 300,000 employees, or 20,000 or 30,000 employees. But one way to make sure that a CEO will never have a company go bust from derivative mishap is to make him sign a paper that says he understands every single transaction, right, that goes on in that company. So what he would do is, he's not going to make himself an expert in all derivatives. What he would do is make sure that company flies below the radar once it comes to in terms of complexity. You need to think just like that CEO who would be prudent. Don't invest in something that you don't understand because Earl is doing it, or because it sounds cool, or because XYZ. The only reason you invest in something is because you understand it totally, both the risks and the reward. Okay? And principle number 3, the last precept, is basically building upon the first 2, particularly the risk versus reward. I go about thinking of life, most transactions in life, as a transaction, not necessarily a financial transaction, but a transaction which is a trade-off of risk and reward, investment versus return. I've just started transforming the blog into basically a mini school, and the school is basically attempting to recreate the apprenticeship relationships of the past, where I attempt to impart knowledge. A lot of schools, in terms of academics, the traditional academic schools, they have tuition. Students go and pay tuition. They get large loans, pay tuition to get a degree, and they think that's success. Unfortunately, you can't eat degrees, and degrees don't necessarily produce income. The only thing that produces income is income, basically. So you have to look at the return that you will get on said degree. Okay, so what we've done is we've taken degrees, we've taken expected salaries, the cost of the degree, the cost of living while you get the degree, and get a financial return out of it. Many degrees for many of the brand name schools are actually negative return. You actually take a loss, which means you've been better off interning for free with Google, right? Working on Android for 4 or 5 years, versus going to a university, paying $160,000 at 6% interest, and then trying to get a job with a computer science degree. An astute employer would say, this person helped develop Android, I'm gonna hire him, versus, the 4-year degree from XYZ University, and not to disparage your school. So that's just a different way of looking at things. Always look at things in terms of the return on your investment and the risks that you take in pursuing that investment.
Excellent, excellent. Reggie, you know, we're going to continue our discussions. We're going to do a lot of things with BoomBustBlog and Urban Wall Street because the knowledge you have is infinite for me. I'm sitting here, you know, in amazement and happy to know you and you know, have gone to school with you and be in a position that we can collaborate and bring this knowledge to my audience and audiences, you know, around the world. So it's a beautiful time, and I want to thank you. But I want you to do it in 60 seconds before we get out, because I did mention the education bubble, and you perceived that. So in 60 seconds before we wrap it up, and I really want everybody to pay attention to this, the education bubble, 60 seconds, what's going to happen with that?
Okay, same thing happens with all bubbles. Bubbles come when you have a flood of liquidity that comes in, right? And because you have so much money, people use that money to build up an asset. The asset is built up beyond what it's worth, and then eventually that liquidity floods out, you know, leaks out, the asset pops, the bubble pops. The asset values that people thought were worth 10 are now worth 5, with debt at 8, and you're underwater 3. So, you know, if you follow the math, you already have a 22% default rate in many student loans. It's going to be roughly about $3 trillion by the end of next quarter. And then you have the diplomas backing these loans. What are the diplomas worth? Well, I just ran through the example of interning with Google versus getting a 4-year degree, seeing which is worth more, especially considering the $172,000 of debt you would have been in. So that's a quick 60-second description of that student loan bubble. You know, there's of course much more to describe and discuss, but that's for another show.
Right, for another show. And if you want to hear some more information, of course, you can listen to Reggie and hear his knowledge and wisdom at BoomBustBlog.com. As always, the Urban Wall Street Project wants to bring you the best. We want to bring you the people who know their field and can help you get to where you want to be. As I always say, be mindful, be prosperous, keep watching, keep your head up, do your diligence in any area that you want to be successful in, and keep the faith and stay positive. Until next time, peace.